Good morning, everyone, and welcome. For those of you in my Accounting for Decision-Making course, what we're covering today is, well, it's absolutely fundamental. We're going to move beyond the day-to-day transactions and start looking at the big stuff, the long-term investments that really form the backbone of a business. We're talking about accounting for plant assets. And I want to be clear from the start. This is not just about debits and credits. It's about learning how to read the strategic story of a company. Because when you look at a balance sheet, that plant assets section, it's telling you something. It tells you what a company's betting on, what it thinks will drive profits in the future, and how it's actually equipped to compete. Mastering this is really your first big step from being a bookkeeper to becoming a strategic financial analyst. Okay, so to make this real, let's dive into a scenario that I think we can all picture. Imagine a brand new coffee shop opening up down the street. They've got a solid business plan, a great location, but to make that truly amazing coffee, they need one thing: a professional, top-of-the-line espresso machine. Now, this isn't a small purchase. This machine is the heart and soul of their entire operation. So the question is, how do they record this thing when they first buy it? How do they account for its value as it pumps out thousands of lattes over the next few years? And eventually, what happens when it's time to sell it or get a new one? We're going to follow the entire life cycle of this one machine, from day one all the way to the end. All right, before we can start doing any accounting for our espresso machine, we first have to figure out, what is it? What category does it belong in? In accounting, we call it a plant asset. Now, I know the word plant probably makes you think of a giant factory, and sure, that's part of it, but the concept is so much broader. I want you to think of these things not just as lines on a spreadsheet, but as the actual tools of the trade, the productive capacity of the business. These are the engines that generate revenue. You know, things like cash and inventory, those are about the short term. Plant assets, though, they're about the long-term strategy. They're the physical foundation of the whole business model. Now, let's really zoom in on this definition because every single word here is important. Let's break it down. First, long-term. This just means we expect to use it for more than a year. It's not something we're going to use up and replace in a few months. It's an investment. Second, tangible. This is key. You can physically walk up and touch it. It's not a patent or a copyright. It's a real physical thing. And third, and this might be the most important part for an accountant, used in business operations. An asset is only a plant asset if it's actively helping the company make money in its main line of business. For instance, a delivery van for our coffee shop, that's a plant asset. But what if a car dealership owned that exact same van? For them, it would be inventory because their business is selling vans, not using them to deliver coffee. So its classification depends entirely on how the business intends to use it. That's a really critical distinction. So let's apply this definition back to our coffee shop. The espresso machine, yep, definitely a plant asset. It's tangible, it's long-term, and it's right at the center of their operations. The delivery van they buy for catering gigs, same thing. The actual storefront building they purchase, a classic example of a plant asset. It provides the physical space they need to operate. And you know what? Even the point-of-sale system, the cash register and credit card machine, that qualifies too. It's a long-term, tangible piece of equipment that's essential for making sales. Every single one of these represents a major long-term investment in the shop's ability to do business. So, the coffee shop owner has picked out the perfect espresso machine, they sign the check, and it's delivered. What happens now? Well, the very first accounting step is to record its acquisition. And the number we put on the books at this exact moment is incredibly important. It's not just a random number. It's governed by a foundational principle in accounting that really ensures the entire balance sheet is reliable. This number is the starting point for the asset's entire story in our financial record. And this principle is called the historical cost principle. It's truly a cornerstone of financial reporting. Now notice that key phrase, and get them ready for their intended use. This is so important. The cost isn't just the sticker price on the machine. It includes all the other reasonable and necessary costs to get it in the door and ready to brew coffee. So we're talking about sales tax, shipping fees, insurance while it's being transported, maybe some assembly and installation costs, and even the cost of running a few test batches before you open to the public. All of these costs get capitalized, which is just a fancy way of saying they get bundled together to become the total cost of the asset on the balance sheet, instead of being expensed right away. This is a fantastic question, and one I get all the time. It really gets to the heart of why we have these accounting principles in the first place. Let's say our coffee shop owner is a brilliant negotiator and gets a machine that's worth $12,000, but only pays $10,000 for it. It is so tempting to say, hey, let's put it on the books for $12,000. It'll make our company look more valuable. But you can't. And why not? Because that $12,000 market value, well, it's subjective, isn't it? It could change tomorrow. The $10,000 costs, on the other hand, is a cold, hard, Objective fact. We have a receipt, we have a canceled check, an auditor can trace that number. Historical cost gives us a reliable, conservative, and auditable number to anchor our financial statements. It keeps things grounded in reality. Okay, so we've followed the rules, we've recorded our brand new espresso machine on the books at its full cost of, let's say, $10,000. But we all know that machine isn't going to be worth $10,000 forever, right? As it's turning out cappuccinos day after day, year after year, it's being used up. Its ability to generate revenue is slowly being consumed. This is about telling the financial story of how we use up that initial cost to make money over time. Accounting needs a system, a mechanism to match the cost of using the machine with the revenue we're getting from selling all that coffee. And that mechanism is called depreciation. Let's really pull this definition apart, because it perfectly explains another core concept, the matching principle. You're going to hear this a lot. The matching principle basically says that we have to match our expenses to the revenues they helped us earn in the same time period. So our espresso machine is going to help us sell coffee for, say, 5 years, instead of taking the entire $10,000 cost as an expense in year 1, which would create a massive, misleading loss, and then make profits look artificially high for the next 4 years. We allocate a piece of that cost as an expense in each of the 5 years. This systematic and rational allocation gives us a much more accurate, much smoother picture of our company's profitability over time. Okay, everyone, I want you to write this down. Highlight it. Put a big star next to it. This is probably the single most common point of confusion for students. Depreciation is an accounting concept. It is not a cash transaction. The cash left the building way back when we first bought the machine. The annual depreciation entry we make is just moving a piece of the assets cost from the balance sheet over to the income statement as an expense. It's just an internal allocation on paper. No check is written, no money changes hands. This is why, when you get to the statement of cash flows, depreciation is one of the very first things you add back to net income. Understanding this distinction is absolutely fundamental. So how do we actually calculate this allocation? It's a pretty straightforward 4-step process. First, we need the cost, which we already figured out is $10,000. Second, we have to estimate its useful life. And I want to really stress that word, estimate. This isn't a hard fact. It's a judgment call by management. How long do we realistically think this machine will be productive for us? Let's say 5 years. Third, we have to estimate the salvage value, another educated guess. What do we think we could sell it for at the very end of its life? Maybe $1,000 for parts. And finally, once we have those 3 numbers, we choose a method for how to spread that cost out. By far, the most common and easiest method to understand is called straight-line depreciation. The logic behind it is really simple. We're assuming the machine provides its benefit to us pretty evenly over its life, so we should expense an equal amount each year. It's fair and simple. Now, there are other methods, like accelerated methods, that front-load the expense, which makes sense for things like computers that lose their value really fast. But for a sturdy machine like this, straight line is a perfectly logical choice. So for our machine, the math is $10,000 cost minus the $1,000 salvage value divided by 5 years. That gives us an annual depreciation expense of $1,800. This table shows you exactly how the numbers play out over the asset's 5-year life. Let's walk through it. In year 1, we record $1,800 in depreciation expense on our income statement. The total depreciation we've taken so far, which we call accumulated depreciation on the balance sheet, is also $1,800. So the machine's book value, that's its original cost minus all the accumulated depreciation, drops from $10,000 down to $8,200. See how that works? Then in year 2, we do it again. We add another $1,800 of expense. The accumulated depreciation account grows to $3,600 and the book value keeps shrinking. This continues until the end of year 5, when the book value is exactly equal to that $1,000 salvage value we estimated at the beginning. The cost has been perfectly allocated. Let's be crystal clear on the difference between these two terms because they're easy to mix up. At the end of year 2, if you were to look at the coffee shop's income statement for that year, you would see a line item for a depreciation expense of $1,800. That's it. It's for that period only. But if you looked at their balance sheet on the very last day of year 2, you'd see the espresso machine listed at its original cost of $10,000 and right underneath it, a line that says less accumulated depreciation of $3,600. That gives you the net book value of $6,400. So one account is for the period and the other is a running total for the asset's entire life. Of course, the story doesn't always go exactly as planned. An asset isn't always used for its full 5 years. Maybe a revolutionary new machine comes out that's twice as efficient and the owner decides to upgrade. Or maybe the business is growing so fast they need a much bigger machine to keep up with demand. When this happens, a business will dispose of the old asset, and that event requires its own specific set of accounting entries to take it off the books and record whatever happened financially. All right, class, let's put on our manager hats for a minute. It's the beginning of year 4. We look at our depreciation table and we see our espresso machine has a book value of $2,800. Suddenly, a rival coffee shop calls. Their machine just died, they're desperate, and they offer us $3,000 cash for ours, right now. From a purely numbers perspective, what's the outcome here? And more importantly, thinking like a manager, should we actually take this deal? So how do we handle this on the books? It's a 3-step process to record the transaction. First, and you must always do this, we have to update depreciation right up to the date of the sale. Now, for our example, we'll keep it simple and assume the sale happens on January 1st of year 4, so our depreciation is already up to date through the end of year 3. Second, we identify the final book value, which our table tells us is $2,800. And third, and this is the important part, we compare the cash we got to the book value we're taking off our books. That comparison is what determines if we have a gain or a loss. And here's the result of that comparison. We received $3,000 in cash, which is more than the asset's value on our books, the $2,800. This gives us a $200 gain on the sale. Now, why is there a gain? What does that really mean? In essence, it tells us that our original depreciation estimates were a little too aggressive. We were expensing the asset's cost a little bit faster than its actual economic value was declining. This $200 gain would show up on the income statement, usually in a section like Other Revenues and Gains, and it will make our net income for that period just a little bit higher. But here's the most important lesson of the day. We booked a $200 gain. The accountant is happy, net income looks good. But wait, hold on. As the manager, you have to think, we just sold the heart of our operation. How are we going to make coffee for our customers tomorrow morning? What's the downtime going to cost us in lost sales? And what is the replacement cost for a new machine? This is the critical takeaway for you as future business leaders. The accounting result is just one piece of the puzzle. It informs your decision, but it doesn't make the decision for you. You have to weigh that small accounting game against the massive operational reality. So let's bring all of this together. We've just walked through the entire life cycle of an asset, from purchase to disposal. You might be thinking this is just a bunch of mechanical rules and formulas, but I hope what you're starting to see is that these rules are actually the language that we use to describe a company's physical, long-term strategy. And understanding this language is absolutely essential if you want to make or even just evaluate smart business decisions. So, what are the big ideas you need to take with you into your careers? First, plant assets aren't just costs on a page. They are the strategic investments that make future revenues possible. Second, remember that depreciation is a management choice. How you depreciate an asset directly impacts your reported profit. Third, that book value number is the starting point for all kinds of capital budgeting decisions, like whether to repair an old machine or replace it. And finally, if you carefully analyze the gains and losses on asset sales, you can uncover some really powerful insights into a company's reinvestment strategy. When you really learn how to read the plant asset section of a company's financial statements, you're doing so much more than just looking at numbers. You're reading their story. You're reading their strategy. You can see what they're investing in, how quickly they're updating their technology, and how well they're using their tools to make a profit. It's an incredibly powerful analytical tool. So I'll leave you with this final thought to chew on. Let's say you're analyzing a company, and you notice that they reported huge gains from selling off a bunch of their old equipment this quarter, and because of that, their net income looks fantastic. So, is that a sign of a smart, healthy company that's modernizing its operations, or could it be a warning sign? Could it be a company that's struggling to make a profit from its main business, and it's selling off assets just to prop up its earnings for one quarter? The answer's in the details. And now, you have the tools to start digging in and finding that answer. Thank you.